we're in the middle market, and at the deal size we do, I don't think there's enough liquidity to the securities to create necessarily innovative structures on the debt side as you go into the transactions as some of the larger deals. I think the innovation in the middle market is more sector specific, so regardless of whether we're doing a pharmaceutical deal or a device deal or a service deal, there are elements of each of the transactions which basically have innovation to them that enable the transactions to work. So for example, on the device side, we have an orthopedic contract manufacturer called Paragon, which we bought in partnership working with the guys at Johnson & Johnson. They sold us their factory on the West Coast. What drove that transaction was a simultaneous long-term agreement with J&J for 4 years, which enabled us to underpin the financing. So the credit actually looks to our managing, in effect, a Johnson & Johnson factory, the profits coming off of that, profit splitting, to get more leverage than our company, Paragon, would have gotten on its own. Over in the pharmaceutical space, we recently sold JDS. We actually partnered with Galen on the transaction to Novan. I think you guys helped, our colleague here to the left helped us with that transaction. JDS was bought from Solvay, the Belgian pharmaceutical company, and we bought Lithobid, which was lithium, and put it under our management team. The innovation there was closer to really John's world, not quite as organic as some of the royalty things John was talking about, but there was no way to justify the value in the price off of current sales. So we paid about 2x, but then worked out, in effect, royalty streams that gave a share to the seller on the upside as our management team did a good job with the CNS portfolio of assets we acquired from Solvay. And then lastly, just an area where I think there's a lot of innovation going on is over on the service side, particularly for hospitals and the rise of the REITs and their cost of capital. We're half a dozen or more REITs, and their cost of capital is such that companies in our portfolio, Brim, which we bought from LifePoint Province, is a management company. We don't see those hospitals having enough return on investment and return on equity to justify private equity returns. But by partnering with the REITs and separating the management company from the real estate, we can generate tremendous returns. And so every deal that we do in the middle market, again, we don't have the advantage of toggles and picks and all sorts of creative structures at the top level, but we're doing the same thing and trying to play around with the cash flows and the profits in a way to enhance our equity returns.